So I just want to say thanks for coming out and welcome. You will be muted. That is just so that we can record this and share this with other clients that couldn't make it today. Feel free to start asking questions whenever you want. I'll probably be doing like a 3 or 4 minute intro here, and then we'll get going with some Q&A. As expected, we've begun to see some economic data, and it is as bad as we thought. We had two weekly reports of unemployment. One report was for about 3.3 million people. The next report was over 6 million people. And the first report was 5 times the prior record set in the 1980s. Obviously, the second report was twice as big as that one. And so in the weekly unemployment numbers, the number of people that are actually applying for unemployment, that's really, really big and really, really negative. However, there's something that is new this time around that everyone ought to know about, and that is, put simply, the unemployment benefits were expanded to a lot larger potential audience. So what I mean by that is people that were independent contractors before couldn't have applied for unemployment. People that were self-employed before couldn't apply for unemployment. This time around, the gig economy, everyone in the gig economy, everyone that was self-employed, everyone that was a contract employee can apply for unemployment. So we're not looking at apples to apples comparison, for one. For two, we're just expecting to see very, very big numbers when it comes to unemployment. And when we see GDP numbers, we're also going to assume that those are going to be very bad numbers as well. And we think it's going to get a lot worse over the next couple of weeks. We believe that the market knows this, and the really bad economic numbers are basically already baked into the prices that we see. So as you know, life is messy. We tend to organize this mess into our own tidy narratives, maybe so we can sleep better at night, but the mess remains just underneath the surface of that narrative. So surprising things happen all the time. If you can think about all the different kinds of potential once in a century events, if you had 20 potential once in a century events, then you should on average get one every 5 years. These are different events, but they're all kind of events that can happen once in a century. What we're going through right now is one of those kind of events. We don't anticipate to have lots and lots and lots of these, but we have had a lot of surprises in the past. They're unlucky events. They change our lives. They move markets. They change the world as we know it. Just a few of those: we had the Asian debt crisis, we had a dot-com crash, we had 9/11. There was a global financial meltdown. There was Fukushima. There was European sovereign debt crises. All kinds of things are happening. And these are all reminders of sort of the inherent messiness of life and markets. It is uncertainty that markets don't like, right? And it's easier to recognize that idea of uncertainty when we're going through a crisis, but the uncertainty is always with us, just under the surface, waiting to come to light. Now, we're going through a really big period of uncertainty, and it's easy to say that this current scenario could have been predictable, but we forget that at any point in time, there are thousands of predictions of potential outcomes. Pandemic was actually, if you look back to 2015 and Bill Gates's TED Talk, pandemic was one of the things that was predicted alongside thousands of other things. We didn't plan for any of them enough. We planned for all of them a little bit. Looking forward, there are many possibilities. Looking back, there is just one. And so we can look at that and say, why weren't we more prepared? But that's an ex post narrative fallacy. We get to call that hindsight bias. When we look back and we wonder, why weren't we more prepared? It's because we saw this as one of many, many potential outcomes. Now it is the outcome, and it's easier to say we should have been planning for it. So today, I want to remind us of two things. When we're looking forward, humility is our only stance. And it is because that we look forward with humility that we are goal-focused and planning-driven advisors. This is why we practice planning first. This is why we practice broad diversification and appropriate asset allocation. This is why we do what we do. And then the second thing I want to remember today, before we get too deep, is I want to express a few gratitudes. I've noticed a couple people, that I just want to say thank you to. And For one, Scott and I had a review session with a couple last week on a Zoom meeting, and one of the guys is a frontline ER doc, and he came to the Zoom session in full garb. He had mask on top of mask with a shield on it. He had the thing over the cap on, thing came in over his ears. He had his gloves and everything on, and he was on this Zoom meeting. He took a 10-minute break to come and chat with us from the ER. And I just want to say thank you to him and to all people like him. I'm glad he has all that personal protective gear. We recognize that not all the folks that are doing it do. That's a shame. But thank you to all the people on the front lines. A little bit less risky, but also doing things that's supporting us all. We have a client whose son is working in a local supermarket, stocking shelves and bagging groceries, and somebody's got to do that. Like we're going in and toilet paper's gone, but every single day, these people working in the grocery stores are restocking these things, and it's a critical piece. I want to thank you to a woman named Nancy who's working on policy and management response specifically for those in our homeless community in the Berkeley and Oakland area. She's the one that gave us a list of places you can give, and we shared that list last week with folks. It's on our website too if you want to look at that. I want to say thanks to the teachers and the administrators who learned an entirely new set of technology to enable at-home learning for our kids in an incredibly short period of time. I want to say thanks to Zoom for scaling from 10 million users to 250 million active users in less than a month. I want to say thank you for doing that, and I believe that they're going to continue working on some of those security issues. I want to say thanks to moms and dads who filled in that gap of the education while the schools were coming up to speed. We sort of thought in the beginning that maybe we'd be back to school in a couple of weeks, and now we're starting our third week in stay at home right now. And for us on the team, the most important thank you I can say is to our clients, because you've actually used the financial plan kind of how it was designed as the light at the end of the tunnel. We've talked about it a lot, about how our plans are stress tested, how our plans call for cash on the side, how our plans have different pieces that are accessible no matter what markets do. And we recognize that this is the most difficult time for you to listen to us, for you to watch markets, and we really appreciate that trust. Thank you. It is with kind of humility and gratitude that I wanted to begin this call today. For those of you who are curious, I recorded a video last week that's specifically talking about the CARES Act. I think it's up on the website now, and it may be on the top of our weekly commentary today. There's a lot of detail, and I'm really impressed with it. I'm happy to go into some depth on it today if anyone does have questions. But I think it does a really good job of protecting big business, and does a really good job of protecting individuals who are going to be suffering from unemployment. And we get into a lot of specific details on that video. The place I think it falls down a little bit is it doesn't probably do enough for small business and maybe for folks that weren't fully employed or were recognized on their parents' taxes, because they're not going to get benefits. Their parents might get some benefits for them, but they're minimal benefits. So with that, I'm gonna stop, and I'm gonna see Scott or John or Gail or David. Do you guys have any comments or anything you want to say before I start taking a question or two? And if you do, say so in Slack or in chat or something like that. If not, then I'm going to answer the first question that came in. So I assume it makes sense to not do an RMD in 2020 as previously required for this year. Yeah, I mean, definitely the first thing is if you have an opportunity to not withdraw from portfolios and you can survive on the cash you have on the sidelines or from income on a taxable portfolio, definitely don't take withdrawals. One place you may not take withdrawals from if you choose is a required minimum distribution. They did eliminate that as a requirement. And if you happen to have taken one in the last 60 days, it may make sense to roll that back in. We have the opportunity to roll it back into your IRA. Right now there are no questions, but Scott did give me a layup here. Why is the overall market up today? I think that, I mean, the reality is we don't really know. Anyone that sort of takes that to a single answer is delusional, probably. So I may come off as delusional, but I think that the thing that we're all really, really scared about is that the numbers of infections goes up, 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 up. And what I think we're seeing in national numbers and global numbers is the speed of the increase is reducing. The numbers are still going up, but it is not the numbers going up that we anticipate to decline first. We anticipate the first decline will come from the speed of the increase. And it's actually, the increase is decreasing, if that makes sense. So I think that gives a lot of people hope that even though we will probably have to deal with this for a number of months, 12 to 18 months all in, we are flattening the curve and protecting our healthcare system. So that's successful. And California is a leader in this space. We've definitely been successful in California thus far, especially Northern California. When we have our team meetings, John talks a lot about how incredible our Northern California mayors and the governor of California was, and how quick they recognized this. Have a chat that came in, not naming names. Somebody had a call with an analyst in Argentina where the banks are closed. She asked about the banks here. Banks in the United States are considered, and actually so are we, we're considered essential services. So it's possible that one might see less banking staff. Many of the folks that are in the banks that are maybe doing certain jobs aren't there anymore. So you'll see a reduced staff, but I think you'll see banks open. And much of the financial services world is open. Much of the medical world is open. Much of the technology world is open. Here in the Bay Area, the folks that have lost their jobs are primarily in restaurants, tourism, travel-oriented kinds of things, and all of the jobs that are affected by those areas. All right, I'm gonna unmute somebody. Let's see here. Go ahead, Scott.
So I thought it might be useful to just share with the folks on the call maybe some of what we've been hearing and some of the actions that clients have been taking. And so we've had a couple of clients recently, one of which sold his home, and he had proceeds of his home to put to work, whether the bank, checking, savings, CDs, the marketplace, et cetera. And he's 50 years old. That may or may not, be in line with where you are in your life, but just to give you, the scenario, the case study. And so what we were trying to figure out on behalf of this person was he wanted to put the money to work in the markets. He felt like his runway to 95 is quite a long distance out. He has a financial plan like he should. And with that being said, the decision was, do we put the money into work this week all at once, or do we put it in 3 different tranches, right? A third, a third, a third. And the discussion really centered around, what does the evidence show? The evidence shows over long periods of time, we're not market timers, no one can be. And over a long period of time, whether it's here, whether it's 4% higher, whether it's at a month from now, his long-term outcomes are still going to be super favorable. So what we ended up deciding for this person was, I think it was like 600,000. What we decided was we put 50% in this week, and we're going to go a month out with the other 50%. It's not that there's a science to this. Again, the evidence shows you put the money to work when it's available, but there's an emotional and a brain component to this that says, I don't want to put the money to work and be down 3,000 points tomorrow. So in this client's case, what we did was we put the money to work this week, and then the other half's going next week. And another client, similar example, a little bit older, and her scenario was the money was coming into our firm for the first time. And I thought she was really smart and astute in realizing, I don't want to try and guess and time anything. When it gets in here, let's put the money to work. And so I just wanted to share these 2 case studies because they're very real, they're very fluid, they're very now for us. And we believe that these clients are doing what is in the best interest of what their plan tells them they should be doing. I think we really want to remind everybody, the plan really dictates all the decisions we're making for clients, including you guys. That's it.
Thanks, Scott. All right, I've muted Scott again. I'm back on. Any questions from the audience? I did want to share a couple other just anecdotal things. In terms of, we probably have And John, you can probably confirm this in our Slack channel if you don't need to. But we've probably had 24 clients after one of these recordings where I said, hey, maybe a time to reduce the amount you're pulling out. A couple dozen clients have called and said, okay, I can reduce my monthly cash flow from 3,000 to 2,000. And in almost every case, they've said, what am I spending it on anyways? Like, no one can go anywhere. No restaurants are open. You know, I hear that the wine shop in Kensington, one of John's favorite haunts, is still doing pickup business, so you can get a glass of wine or a bottle of wine there. And then at the same time, we've had clients who've said, you know what, you've told me to keep this 18 months, 2 years of cash on the sidelines, and what do you think? Should we put a little bit of that to work? And so we've done that in a couple of instances, taken 3-4 months, not a lot. We want to make sure that people have that emergency fund, but we've taken a little bit and added it back to the portfolios because it is an opportunity. I do have anonymous question. Let's see here. I'm now getting Social Security and have money from a rollover retirement account I can draw from as needed. Roth account is in mutual funds with a risk factor of 5 out of 10, which is down almost 14% this year, 60% for the year to date, 6% for the last 12 months. Should I lower the risk on my Roth account? I would say no. I would say that you have Social Security, you've got money from a rollover account that you can draw on as needed. Roth is the last money you'll ever use. I think you can either leave it the way it is, maybe rebalance it here, which is what the first thing we do, or the thing I don't have here is I don't have age, I don't have those kinds of things. So there's details here that I don't know. But if you made it a 6 out of 10, that now would be, if you're ever thinking about making a 6 out of 10, now would be the time to do it. Or in here somewhere. I'm not. When I say now, I don't mean this is the bottom and everything's going to be up from here. That's not what I mean. We never can pick a bottom. No one knows until months later where the actual bottom was. What we know is 3 years from now, 4 years from now, this will literally have no lasting effect on company earnings. And company earnings long term are the things that drive stock prices. When earnings go up, then prices go up eventually. When earnings go down, which is the anticipation, we see markets responded to the anticipation of earnings going down, and that's why it's following earnings, the expected earnings. So I think that I'd leave it, rebalance it, maybe go from a 5 to a 6 on risk. That's not a question. Are there any other questions? Scott, can you think of any questions that we've gotten recently? I had a client who asked me this morning. He's got money on the sidelines. He's had it for a long time. He was intending to buy a house and ultimately decided about 4 or 5 months ago that he wasn't going to buy a house. And so he has this money that he's been saving, and he's been trying to come up with the time to put it to work. And he said, okay, Jonathan, it's available, but I want to wait 2 weeks for the numbers of infections, for more information on the numbers of infections. And I basically said, that's fine. I wouldn't wait for something like that, because it can go either direction. Markets have already anticipated how bad this is going to be. And maybe the market's right, maybe the market's wrong. But it's not as if any one of us has a piece of information that not everyone else has access to. When we think about this, the market actually looks at and thinks about, and it's basically a voting mechanism. Every one of our opinions is in there. The most dire, horrific potential outcome is in there. The most positive, optimistic, Pollyanna-ish argument is also in there. And what the market is in any moment is an average of all of those estimations. And that's why we think generally that the market kind of knows. And that's why we're trusting that, again, looking back at this 3 years from now, we will look at this and say this was a good time to invest. Okay. Question came in. Is anyone projecting how local economies will restart and employment be restored? especially for small businesses, restaurants, service business who will need to reopen with little capital, rent due, et cetera. People who've been living paycheck to paycheck will be wiped out in a month. Government help is inadequate. There will need to be a lot of local investment is building back how this happened. So a couple quick comments. So the people who are living paycheck to paycheck are actually, can you put that question back up there? I may need to reference that again, or I can go into it, see it. There's a lot there. I'll go into the other screen and see it. I got it. So people that are living paycheck to paycheck are actually treated very well for the next 4 months. They have their unemployment, which is going to be a percentage of their income. And then the state of California, it's like 45% of your income you'll get as California state unemployment. But you also have $600 from the feds, and that isn't a percentage, it's $600. So the calculus works something like this. If you have an income in your household of less than 50 grand, you're gonna actually make more money not working. Probably, maybe it's 48, maybe it's 52. I'm not getting specific calculus here, but you're gonna do fine in terms of your income for the next 4 months. If you made $70,000, your income's going to go down. You're going to have to cut spending on some things to bridge the gap. Hopefully you have a little bit of savings. But most people that are paycheck to paycheck, the restaurant workers, the folks that are working in the tourism industry, the folks that are working in many museums, hourly wage workers, those kinds of folks are going to actually have a very, very good unemployment benefit once they get through the unemployment hotlines and the websites, because I know that they're crashing left and right. It's very difficult to get your unemployment benefits right now. So I'm not worried about the individual so much. I think we've done a good job in this tier 3 benefit. This is the first phase 3 benefit that the feds put together. And big businesses are going to be fine. They're going to be able to hit the capital markets, and they're going to be okay. You're right in that small businesses get the brunt of this. And most of those small businesses, restaurants and retail shops will have access to the PPP, which will pay for 2.5 months of their payroll, pay for their rent, and pay for their utilities. And here's the kicker: to the extent that they've maintained 75% of their payroll. So when I say maintained, that means that they may have let them all go 3 weeks ago and then hired them all back now. And that in that way, 75% of their payroll will have been maintained in terms of a timeline. The challenge will be for them in meeting payroll between now and when they get the loan that will one day be forgiven. But I'll tell you this, a buddy of mine who runs that, I've mentioned this in the past, who runs a retail store, he actually applied for a loan immediately. Like, this is probably 3 weeks ago, 2 weeks ago. This was the disaster loan. This is before PPP was even out there. And he's already been notified that he's already received a $10,000 initial check that is forgivable. And he's already been notified, which, that's 1 month's rent. That's a nothing thing, but it helps him bridge the gap. He's also been notified of a loan that's way bigger. We're talking 10 times bigger than what he expected to get. That will more than enable him to cover his payroll, to cover his rent, to cover, and terms are such that he has 30 years to pay it back, and it's a very, very, very low interest rate. So he will be able to dig out from this. I think most restaurants and retail stores that actually look at the benefits that are out there, I think that they will see that there will be a benefit that applies to them, and they will be able to take advantage of that. That being said, there will be, because of how precarious restaurants and retail is to begin with, there will be perhaps a number of stores that don't recover. For every store that doesn't, let's just use retail. If a retail store that sells clothing doesn't recover, that doesn't affect the demand side. It affects one supply location of clothing. The demand stays the same. And so those people who were buying clothing before won't have that shop as an option. They'll have to shop elsewhere when they decide to buy stuff. That's true of clothing. It's true of retail food outlets. It's true of restaurants. It's true of tires. It's true of any good you could purchase. So there will be other companies, small businesses, that are started in this process. There'll be other ones that don't have a lot of overhead or maintain low overhead that can actually expand in this process. And I think that's what, my buddy who's getting this loan is going to do. He's going to actually use this as an opportunity to expand and compete with much larger stores like his. And frankly, he's going to try to compete a little bit better with Amazon with his digital presence. So I think there's definitely going to be businesses that fail. Individuals are taken care of. There'll be businesses that start. Necessity is the mother of invention. But there's a third part to this, and that is, if you remember 2008, we went through 4, 5, 6 iterations of, rate reduction, quantitative easing. We'll figure this out. The feds will do something. I don't anticipate that we've seen the last we've seen probably the last recovery stimulus, but we probably then will see a kickoff stimulus. We'll probably see something that comes, and we'll call this phase 4 or phase 5, that does a better job of giving businesses the ability to expand, maybe giving some businesses the ability to start, protecting businesses that are more on the edge than anticipated. We're going to see another phase of this that will help small business more, I anticipate, and may extend that 4-month window benefits for individuals on unemployment, so that they'll have a greater period of time to seek new work, for sure. Okay, I hope that answers that question. I think I covered it. I think I covered every little piece there. Any numbers on consumer spending? Yeah, it's a great question. No numbers are out yet. Yes, we are spending an inordinate amount less than we would have been had this not happened. We're spending probably more on delivery than we would have before. We just finally got our last weekend. We got our Instacart. We got our first Instacart delivery, and I think I figured out how Instacart makes money. I think they mark up every single item in the stack, every single item. So it was really expensive groceries. I think most of that went to Instacart and delivery there. We also did an Amazon Now order for stuff that didn't come from the Instacart order. They couldn't get stuff. So we did 2 different deliveries and we got stuff here. So delivery is going to be much bigger in terms of our expense. Also, streaming media. I think that we mentioned this, I think, last week or the week before. Disney's, locations are closed, but Disney Plus is doing bang up business. There's going to be so many people that subscribe to Netflix and Disney Plus, and I know that there's a bunch of places that are offering free streaming services with, it'll be free for a couple months, and then they'll begin their initial subscription hit. And if you like some of their shows, they're going to pick up business from this. So there's going to be a lot less spending in general. But what does that do for those of us who our incomes are continuing? That means we don't have a place to spend money, but we will have the ability to spend later. And so when you look out and when you talk to the analysts and strategists at Goldman or at JP Morgan, or when you look out for the full year, this is going to be really bad in Q2. Middle of Q3 and Q4, we're going to see massive increases in spending. So on net, over say 2020 and 2021, put those 2 things together, consumers are going to spend a lot of money. It'll probably be slightly less than it would have been because they won't have as much. We won't have as much income to spend. But into 2022, we'll be back to right size in terms of our consumer spending. Okay, so that is that one. Let's see here. I don't know how these get ordered. Oh, here. Okay, so the first one's on the top. Assuming the U.S. government debt is gonna skyrocket, what makes sense for procuring U.S. bonds for our income portion of our assets, shorter, long term, or stay away from U.S. bonds? It's a great question. I think the reality is, and this goes back to the U.S. debt downgrade, 2011. I think it was 2011, maybe 12. The reason the debt was downgraded, when you go back and look at this, the reason the debt was downgraded in 2011 wasn't because of the US's inability to pay. The reason the debt was downgraded was because of the strife in Congress to agree upon the methods of payment. Would we reduce our future expenses, or would we raise taxes? And what we did is we raised our future expenses and we lowered taxes. So we went the wrong direction, which is kind of why they said, hey, we weren't a good credit. The reality is the US has so much ability to pay, that the bonds, we're going to float. We are floating an additional $2 trillion in bonds now for this. And it'll happen in probably short duration. But then we're going to renegotiate those durations as we go through and the bond auctions for the next 6 to 12 months. You'll be seeing some longer dated bonds. There's talk of a 50-year bond. There's talk of a 100-year bond. Those are difficult to get a lot of demand for out of the gate. But I think we'll see something like that. I'm not actually worried about the U.S. ability to pay. We will pay these debts back. It'll make us a less attractive credit for sure. But compared to what? We've said this for years. Especially after 2008, we pumped a lot of money into the system, and through all the Iraq wars and stuff, we pumped a lot of money into the system, and we still don't have any problem paying for our debt. Actually, our debt service is lower now than it was back then, even though we have so much more debt because of the rates, right? Rates are really, really inexpensive. We have the ability to pay, but we are the cleanest of the dirty shirts. Compared to everyone else's ability to pay, we have the highest ability to pay, and we will ultimately pay. It's just a matter of our politicians getting to figure out how that's going to happen. And that argument will come next year and the year after and the year after for sure. I anticipate higher tax rates. That's what I anticipate. And I welcome those for folks at the higher income spectrum. Okay. Good question here. Someone can let that answer go. Thanks. For those of us who count on residential rental income, is there any sense of whether rents will be affected by the situation once people are working again? So I get a little bit of rental income, and I reached out to the person who manages my properties, and I asked them, if there's any issue, and I may have one tenant that is going to have a difficult time, and so we'll work something out with that tenant. And I'm imagining that's the case that's going to happen for almost all residential rental income. The positive, and this isn't positive, right? But there are some benefits that come out of some of the programs that are put in place. Two of those benefits are debt related. One was for this is the CARES Act. One of the benefits was specifically designed around federally guaranteed mortgages. And I don't remember the specifics. I did a whole thing on it for that video, and it's in the video. But if I think it was 180 days. If you have a federally guaranteed Fannie Freddie kind of mortgage, and this would be much more your single family home or duplex kind of mortgage. If you have a Fannie or Freddie guaranteed mortgage, you have 180 day. You just have to ask for it. You have a 180 day window where you don't have to make payments, and you have the ability for 180 day extension. The second part of this is if you have a student loan, your payments, a federally guaranteed or a federal student loan does not have to make payments until September 30th, and there is no accrual of interest. So part of the CARES Act was reducing the expenses. At the same time, if you don't have a federally guaranteed mortgage, I believe Gavin Newsom made a deal with the 4 biggest lenders in California, Chase, Wells Fargo, B of A, there's another one. And I'm assuming that some of the smaller ones actually follow suit, where there's a 3-month window here or a 6-month window here where they're going to be open to not receiving a payment. So yes, it'll probably affect income. Hopefully there's also something that lets you protect the expense side, and those kind of balance out a little bit. Recognizing that those people that had positive cash flow from their rental real estate, it's gonna be a net negative. Hopefully there's a workout with your tenants. In other words, it's not that they're not going to pay rent ever, but maybe they come back around and they're employed again and they can pay. But that's going to be unit by unit. And believe me, that conversation is being had all over the place. I have 3 clients who I've had conversations with about their rental real estate, and for them, one of them has commercial real estate, and that's going to be hit really hard. And when you look at the REIT market, there's REITs that are off 60% right now. People that REITs have done really, really well for the last decade, outperforming stock markets, et cetera. Those REITs are getting absolutely destroyed right now. So real estate is going to have a hard go until it has a full workout. Similar question related to higher U.S. debt. Higher, you mean higher duration, higher yield, higher risk, higher what? Be a question. I'm assuming we're meaning higher yield. And there's going to be some workouts here for sure. In the high yield debt market, there's going to be a lot of things like energy related things. Like if you have a high yield bond fund that lends or high yield debt that's in the oil patch, there's a lot of that's just going to go. It's going to go to zero. A lot of that's not going to have value. But most other high yield debt, I read somewhere that one of the reasons that some of the REITs are having a hard go is because, for example, Red Lobster is a triple B. They're a high yield credit, and Red Lobster's not serving lobster or seafood or anything right now. So are they going to be able to pay for their rent? No, but there's workouts that they're going to have with those tenants, with those landlords, and any other high yield debt they have is going to have a tough go. So you're going to see a period where the yields are going to go. Some credits are not going to pay, which means the value of the high yield debt itself is going to go down, which means the profitability of that high yield debt that does really well is going to go higher. We're going to be able to buy some of that high yield debt cheaper. That's one of the things we're going to look at to invest in is high yield. We stay away from high yield generally, but in 2008, one of the things we did was we bought high yield because high yield was giving us like 20% returns, interest returns, and we could buy it for 70 cents on the dollar, which, if you assume, 30% of it defaults, then that's tremendous. That's huge. Hold on. Thank you. I'm on a call right now. Whatever you want. Hi, Annie. She's going to be in the recording now forever. So that's high yield debt. Would it be a good time to switch an IRA to a Roth? Yes, if there was a good time, this would be a good time for it. Much depends on the other elements in somebody's plan. Are they already high income? Are they going to continue to be high income? One of the big benefits of a Roth IRA used to be that you could extend that forever and it could generation, but in last year's Secure Act, they changed that. There's now a 10-year you got to liquidate your Roth IRA. So you may get some benefit out of converting to a Roth IRA. It won't be as big a benefit as you would have gotten had the Secure Act not passed. One more question: whatever happened to inflation? Your guess, John, is as good as mine. Going back to the question or the statement about the cleanest shirt in the laundry, cleanest shirt in dirty laundry basket, inflation is really, really dependent upon everyone. And right now, everyone is printing money. Everyone has got a bailout for that, for their economies. If anything, on a relative basis, you may see some strength, eventually you may see some decline in the value of the US dollar relative to emerging currencies, because they don't have as much ability to stimulate. They don't have as much in reserve. They don't have as much taxing ability. They don't have as much ability to raise money in the public markets. So this is long term, 2, 3, 4, 5 years down the road, relative to weaker currencies. You might what we perceive as weaker currencies, our debt load may hurt us relative to those currencies. But right now, we've been trying for a decade to stimulate inflation, and we've been unable to do it. It looked 6 months ago like we were starting to see some. We just don't see it right now, and we are printing a lot more, and so the likelihood of inflation in the future is going up. But who knows? Who knows if we see inflation? So we have about, looks like 18 more minutes, and I'm happy to sit here and wait for as long as people want to think about potential questions. All right, I'm gonna give Scott the mic here. Hold on. Scott, you're on.
Yeah, so it's not so much I have a specific question, but I think it might be useful. The people that keep participating on these calls, sometimes there's 85 people, sometimes there's 50 people, sometimes there's, in this case, 20 something people, and it's not always the same people. And so the question that keeps coming up was, how do we compare this, right, to the last dozen, epidemics that have happened in the last, 30 years, and or when things get really tough in the marketplace like it is right now, and these drawdowns of 20, 30% or more happen, how does this compare to what's happened in the past, and what might we expect as we come out of this based on the last 30, 40, 50 years, that kind of thing. I think maybe talking through some of that out loud to whoever's on the call might be useful. And if there's questions around that, I think that's also something that could be useful for people to look at, what's kind of happened in the past and how does this generally play out with averages and things like this, because that's all you can go with is what history has kind of shown us and what this kind of looks like. So I think it's useful to look at the dozen or so times we've had these epidemics and, what the market looks like a year later, or 2 years later. And then also we've had about 8 or 10 of these bear markets going back for, decades. How long do we, a lot of times people ask, is this a year? Is this 5 years? Like, I don't have 5 years to wait. What's generally the amount of time it takes to come out of something like this? And I think being able to sort of tease that conversation out loud, I think is useful for people to have a little bit of a light at the end of the tunnel. That keeps coming up when I'm talking to people. That keeps coming up.
Okay, let me give it a shot.
Yep.
So I just muted you again, just so you know, if you're trying to talk, you won't be able to hear you. So there's 2 questions in there. The first one was relative to prior epidemics. So we haven't, I don't think we've ever, and since 1918, the flu of 1918, I don't think we've actually seen an epidemic that has the potential expanded infection rate as this one. So in anyone's living memory that I know, this is new in terms of an epidemic, in terms of a health crisis. So we don't have good comparisons in that space. That being said, we do have a lot. In 1918, things did recover. Great Depression happened pretty closely thereafter as well. So I think the more important one, the question I'm getting more, is the second one of those 2, and that is, what is the expectation? What can markets do in terms of how bad can it really get in terms of markets? And the reality is, and this is something that we have to keep in mind all the time, every single transaction, every time a stock is traded or a business is traded, there's a buyer and a seller. And we tend to forget that when prices are ticking down, every tick along the way, there's somebody going, this is a good price. Now, as it goes down and down and down and down and down, the number of people that are value investors are looking for this opportunity. And the most well-known investor on earth falls into this category, Warren Buffett. As the price of things tick down, Warren Buffett starts to salivate. He starts to get excited about some company he can buy outright. And he's not alone. There are, Howard Marks, there are people that manage hundreds of billions, probably collectively trillions of dollars, that have been sitting with cash on the sideline waiting for this to happen. And at the same time, in the more innovative space, there are people that have, there's a pool of private equity capital that's both sort of M&A and then sort of new venture or what's it called? Distressed debt, distressed capital. There's money out there that will be put to work that waits to be the purchaser in this circumstance. So every single one of those guys are thinking, okay, what's my price? And you got to think that, again, this is a market. There's lots and lots and lots of participants. All the way down, there's somebody that's buying. And at some point, we run out of sellers. One of the things that we've noticed in this go round is the biggest buyer that exited was the corporate buyer. It was the company buying back their own stock. Up until February of this year, one of the largest buyers of stock were companies. And it's not that they purchased more stock than anybody else. It's not that they purchased more stock than they had historically. They're purchasing roughly the same, they're using roughly the same amount of their earnings to buy back their stock as they've done in the prior years. But the other buyers, us, the individuals, had largely gone away. And so they were the biggest buyers in the market for a long time. And they stopped in February. So eventually they come back. When they see through the end of this thing, they go, okay, now we can buy back our stock cheaper than we did, 3 years ago. And it's going to affect our earnings, and we're going to be able to put debt to sleep, and we're going to be able to, and we have capital on the sideline, and they're going to see this as an opportunity. Right now, they've got to figure out where the potential lies, but they will figure it out. So markets are working, and I think that's really, really important. And because markets are working, let's think about what are the worst things that happen. In our recent memory, we've had two really big market declines. Both were over 50%. Both going into them, it was unknown what the damage is going to be, or how bad economically it will be, or how many companies would go under, how many people would lose their jobs. It was unknown. In both cases, the economics of it were pretty bad, much worse in 2008 than they were in 2001. The economic recession in 2001 was minimal. It was mainly one sliver of the economy that happened to go down 80, 90%, the tech world. But everyone else was dragged down because they were buying stuff and they weren't buying stuff anymore. They were employing people and they weren't employing people anymore. So 2008 is another good example. The economic impact was really, really big. That was, going into it, the economy wasn't sound. Going into this one, the economy was sound. So the question is, when we come out, what will the recovery look like? And I've heard a couple different ideas about this. And if you go way back, you remember the idea of there could be an L. In other words, we could drop and we could just sort of stay there for a long time and not recover. With all of the assets on the sideline, with all the participants that are out there, they're looking for opportunity. We may see an L for a little bit, but then they're all competing for opportunity, and they will ultimately be buying stuff that's producing and pushing prices up again. And as prices push up again, everyone that didn't buy will get nervous and think, oh my God, and then they'll start buying, and that'll push it up even faster. And then at the very end, those of us who are sitting, those folks that are just acting on emotion, that won't get excited about it until the excitement's in the market, they're going to be the last people to buy, right? That's just like they'll be the last ones that sell when things go down, and they'll sell really, really low. They'll also be the ones that buy really, really high. And they'll repeat that over and over and over again, and always blaming markets and how bad markets are. So how bad can it get? Yeah, markets can go down 50%. I don't see that here. I think that the market is already, we may revisit the bottom. Scott and I were talking about this idea that often when markets go down, they don't just shoot right back up. They often retest. And so we might see that. We might not. I don't know. But if we do retest, I think it holds. And the reason I think it holds is, in this circumstance, we have we don't know the specific end date, but we know the basic solution. We know the basics. We know when this ends, and that it ends when we have a vaccine. And you're starting to see Bill Gates. He's like, we're going to tool up to produce 2 vaccines. I don't know which 2, but we're going to tool up so we can produce 2. Whichever one wins, we're going to start putting it. So that cuts off 2 or 3 months from Fauci's 18 months. We're already 4 months in to Fauci's 18 months. That cuts off 2 or 3 months of the productivity cycle. So maybe we've got 10 months to go till we have that vaccine. There's definitely progress being made with vaccines. There's definitely people being treated with the blood from survivors. There's definitely companies. Actually, there's a company in San Francisco that is synthesizing the antibodies in people's blood, so maybe we can use it once removed, and maybe that'll be the treatment or the vaccine or part of the vaccine. This is working. Again, the narrative in the beginning is this is horrible and very, very, very bad, and it is. I'm not dismissing how bad it is, but against the horrible, against that narrative, there's all kinds of really, really, really smart people working both on the economy and on the virus. And we will overcome this. It'll be time. The worst case scenario is we have to wait the full 18 months. Maybe before then, maybe that's not the worst case scenario. I can think of definitely worst case scenarios, but I don't think we'll see that here. And markets are going to predict long before we get there that we're headed out of it. Maybe what we're seeing in the last couple of weeks after the big decline, after the bottom, maybe that's what we're seeing. Maybe we retest. I don't know the short-term volatility. I hope that answers the question, Scott, a little bit. I have a couple other questions coming in. Once this is over with, what might we learn from this? So this is actually really fantastic, and I've had this conversation with two people, two folks that were really, really, really nervous, and they were looking at the models. By the way, Fauci has said you can't tell anything from models. The guy we're supposed to listen to has said the models don't have very good data. The models are multipliers. They're designed to create action in us, which they've done. We have social distancing because of that. But the two conversations I've had that are very, very interesting are folks that said, Jonathan, I don't want to stay in, and I don't want to put more money in. And so I've asked them, I said, okay, you have a narrative. What I want to ask is, what would cause you to question the narrative next time? So we're going to have another thing like this 3 years down the road, 5 years down the road, 8 years down the road. In this circumstance, it's been 11 years since we've had anything like this in terms of the market and the economy. And so we kind of get a little complacent. We kind of forget what it's like going through it at the time, and that's understandable. But my question to folks who are going through it now, who are really, really, really scared, is if you can't act on a plan now, what is it that'll help you learn from this experience so that next time you can act on a plan? And that is, I think, the really interesting psychological question for folks is 3 years from now, when we're looking back at this and we can actually say without a doubt that it was the bottom, that, we know now that we recovered. We know now that there was going to be a vaccine. We thought there would be a vaccine. We couldn't be sure, but now we know the vaccine is there. We've all had it. This isn't going to happen again. The next virus might happen, but this one is not going to happen again. So what is it that will cause us to question our own assumptions and our trust in the models that people present? Because we should absolutely question those models. And that's, I think, what terrified a lot of people was the projections that they saw in these models. And then compounded by, the stuff they're reading on Facebook and those kinds of things. Okay, got a question. If markets will predict, what would you consider the leading indicators to be? It's a great question. I don't know of the bell. All I know is the markets are gonna move before the vast majority of us expect them to move. There will be many people that are left in the dust around this. So we aren't ones that have sold in a bottom. We actually did a rebalance. We're part of the group that is saying, okay, this is going to pass. This too shall pass. And what should we, in expectation of this passing, what are the behaviors we put in place? I've never known there to be a, when the advanced decline line swaps, then that's the thing. Or when the 50-day moving average crosses the 200-day moving average, that's the thing that determines it. I don't think there is a reliable bell. I know that unemployment's going to shoot up and unemployment won't come down until after the market's moved. I know that GDP is going to go down and GDP won't recover until after the market's moved. The market's going to decide at some point when value investors, rational people looking for opportunity, overcome those people that are looking to exit or escape the pain, the difficulties that markets give us. I won't be able to know exactly what triggers that. That's speculation, and no one does that successfully consistently. And we got about 3 minutes left. Happy to take another call, another question in that time. Otherwise, I just want to say thanks everyone for coming out. We are going to do another one of these next Monday and continue answering questions. Also, if you might have, some of you might have seen this, but on clients saw this, hopefully. On Wednesday morning, we're just going to have coffee, and it'll be much more informal. It'll be more live Q&A. Not everyone will be muted. It's just going to be a much more relaxed Q&A on the topic. And on Thursday, right? Thursday. Yeah, Thursday we have, because Friday is Good Friday. So Thursday we have an event for clients. It's going to be another quarantini, but we're going to actually see a travel story. So I hope you guys will join us. Thanks very much for coming. And we are here. If you have any questions about your plan, any questions about anything that's concerning you about these things, I'm happy to talk further. Scott's there, John's there, Gail's there, David's there. We're all there. And we look forward to seeing you very soon on another meeting. Bye, guys.